Well, the theme for today is that gobs of breath is good. And we've been seeing that, and it says that liquidity is plentiful, and that is a condition that tends to persist for a while. Before I get to the breadth numbers, though, I want to talk a little bit about the stock market's relationship with crude oil, which is kind of fascinating because the big drop in crude oil prices that we saw in Q4 really dragged the stock market down in sympathy. And then the rebound in crude oil prices in Q1 and into Q2 has matched the rebound in the stock market. So you think, oh, okay, all I've got to know is whatever crude oil is doing, and that's what the stock market's going to do. Well, that works some of the time, but you find that throughout history, every once in a while, they go through this inverse correlation where suddenly the nice, perfect correlation of Dan steps flips and becomes inverted. And then it flips back without warning. And I wish I could figure out who is controlling the switch on that. But I haven't figured that out. The place that crude oil appears to have stopped is an interesting spot because not only was it the lows during last summer, but it's at the level of an apex of the triangle that we saw in early 2018. Apex behavior is really interesting in charts. The price level of an apex can have future importance, both in time and in price. In the case of that apex, it marked the top in about May of 2018, but that the level of the apex also established a new important support and resistance level for crude oil prices that hadn't really existed before. And so now we're finally back up to that. We're going to see if we can get through it. It may take a while banging on the ceiling before we can get through it. Reemphasizing this point about the binary condition of this behavior, here's a look at 2015 to 2017, just to see that sometimes it's a positive correlation, then sometimes it's an inverse correlation, then it's back to positive, then it's back to inverse. So once you think you've figured it out, it'll flip on you. And it's not, and I once thought there was a useful cyclicality where the spacing of how long it was positive versus inverse was kind of consistent. It's not really. I wish that was the case because then I could figure out when it was going to flip again. But I have not unlocked the secret of why that operates that way. As interesting as it is that stock prices correlate with crude oil prices in real time, they also correlate with a 10-year lag. This is a leading indication that I've shown before on your show. What I've done in this chart is I've taken the log scale price of crude oil, that's on the top, and I've shifted that forward 10 years to reveal that the movements of the stock market now are echoing the dance steps that crude oil was doing 10 years before. Now, it's not always exactly 10.0 years. Sometimes it's 9.5, sometimes it's 10.5. There's a little bit of what I call accordioning in the alignment of the tops and bottoms, but the dance steps really are still there. A little over 10 years ago, we had this enormous decline in crude oil prices. We didn't see quite the same enormity of the decline in the stock market, but it was still there, right on schedule. And now we're rebounding, just like oil prices did out of that 2009 low. Sometime around 2021, we should get a top and a long broadening pattern. I think that right now, being a trend follower is great. After about 2021, being a market timer is going to be what you're going to want to do because trends are not going to be there. And then when we get out to 2024, that's when the ugliness starts. So whoever gets elected in 2024, whoever that is going to get blamed for the stock market echoing this decline that's already baked in. It's already sized up on the tape recorder here. We're just waiting for that loop of tape to reach the playing head, and then we get that. Here's a longer term view of that same phenomenon. This is crude oil prices shifted forward by 10 years and compared to the stock market. And this is a phenomenon that doesn't really make any sense at all. I mean, how would crude oil know 10 years in advance what the stock market's going to do? It doesn't really have to make sense, though, when you factor in that it's been working for the entire history of the Dow Jones Industrial Average since 1896. And so at some point you say, well, I don't know why it's working, but it works well enough that I can probably have some good faith in it. The theme for today is breadth. Gobs of breadth is great. And so here is the New York Stock Exchange advanced decline line. It's looking at all of the issues traded on the NYSE, and this is the one I usually prefer to look at. It's already been making a new all-time high. It's above its highs of August and September of last year. The Dow Jones Industrial Average and the S&P have not yet exceeded their equivalent high. So the advanced decline line is stronger. And that's a really good thing. In fact, it started showing strength earlier. It was making a higher high here. It broke its down trend line ahead of prices. So it's really saying that there's lots of strength. And the thing that you need to know about the advanced decline line is that it's a very egalitarian indicator. Every issue on the whole stock exchange gets the same vote. It doesn't matter what your market capitalization is. And so that's why it's so useful, because it can tell you something different from what the price cap weighted indexes are saying. And it's also made up mostly of small issues. There's a lot of big cap issues that drive the major indices, but there's not that many of them. And so when you take the votes of the populace and find out what they're all doing, you can find out if liquidity is doing well or if it's doing poorly. We saw back in September that the advanced decline line made a small divergence, warning of the trouble that was coming, and sure enough, we got trouble. And then it made a bullish divergence, making a higher high coming out of that low, confirming that the strength of the new uptrend. One of the big issues that I get asked about a lot is about the different types of issues on the NYSE. And so here's a breakdown of the issues as we track them. We look at all 3,000 plus issues listed on the NYSE. And some people will tell you, well, you really ought to look at only the common stocks, or only the common only advanced decline line, because those are the real stocks. And so that's what you should look at. You should get rid of all the other impurities and other messiness that contaminate the numbers, and just look at this. That's what they tell you. And it's a hypothesis that makes sense, but it's not a hypothesis which survives contact with the data. So here's a comparison. This is the composite NYSE AD line on the top. It's all the issues. And here's a common only advanced decline line, just looking at only the common stocks. And what you find out is that when the two of them disagree, you really ought to be listening to the composite. That the common only version doesn't give you better answers. In fact, it was still making higher highs back in September along with prices, even though we had a divergence in the composite version. And right now it's not making a higher high above last September and above January. So you might say, well, that's a big divergence, but the composite version is saying, oh no, everything's fine. So it's a really a peculiar situation where the hypothesis is that you ought to look at the purified stuff and because that's the best value, but it really turns out not to be true. It's like the chaff is worth more than the wheat. And so we like to look at some of those other things that are in there. And so here is, for example, preferred stocks. It turns out not to be a very good advanced decline line. It doesn't give you warnings when you'd want them. It'll be making higher highs, and then you get a big sell-off. Making higher highs, and then you get a big sell-off. It never gave us a warning of the big decline last year, and so it's not that good. It doesn't hurt anything, but it's just not the best indicator. What we do find is that the types of issues that are most often blamed for contaminating the list is the bond closed-end funds. There's a couple hundred of those, and they tend to be the best indicator ever. They are just the best detectors of good or bad liquidity. They're the canaries you want to hire to work in your coal mine, because when liquidity starts to dry up, they'll show it. This was one of the few places we got a divergence back at the January 2018 top. It shows us a divergence at the September top. And then it showed us strength at the December bottom. It was making higher lows, and it's been showing us gonzo strength all the time during the uptrend. No sign of weakening yet, no trouble, no worries in regard to liquidity, and this should give us a nice early warning. I'm sorry that I can't direct you to any place where people could watch that themselves. We track this data ourselves and publish it when it has something useful to say, and I don't know of a source where anybody else can get it, because it's kind of a pain to track all 3,000 plus stocks and sort them out into different bins that can tell you useful answers. One other way that you can track a similar data, there is an advanced decline statistics that FINRA publishes on corporate high yield bonds and also corporate high grade bonds. So here's an advanced decline line that we track based on this data from FINRA. And if you want to take a screenshot of that so you can grab the link to where you can get that data every day, they don't make it available in a historical data series. So you have to go in every day and fetch the data yourself. But it's such useful data that it's really, really good to track. So here we saw 2016, the high yield bonds were doing absolutely wonderful. They were saying liquidity is really plentiful, that even these least deserving issues could get enough of it. They were disagreeing with prices at the election, and sure enough, they were right. We saw big strength. They were disagreeing, though, with prices at the January 2018 top. They were saying, uh-oh, liquidity's in trouble, and sure enough, we had a problem. They showed another divergence at the September top in 2018, said liquidity's in trouble, and sure enough, they went down as prices went down in the stock market. But then they flipped and said, uh-oh, liquidity is back, strong uptrend starting, and they're still saying that. It just keeps on pushing higher at a very steep rate. That's a message that liquidity is so plentiful that even the junk bonds can get some, and that usually means that there's plenty of liquidity to go around to lift up the rest of the overall stock market. Now, seeing liquidity and strength in the stock market is what's supposed to be happening. We're in the third year of the current presidential term. I like to measure these years as beginning November 1st instead of January 1st, and that's because the election is held in November. And so here we are with a presidential cycle pattern which averages together the S&P 500 in 4-year chunks of time. We're in the middle of the third year, and sure enough, we're following the dance steps of its pattern. When we get to early May, it says that there should be a temporary top and a little bit of a scary decline to mid-May. I'm betting that the decline will feel scarier than it actually is, and that'll serve a useful purpose to get people scared out of the market, so that then we can get in a nice short-term low and then start powering higher again. But for now, until about the end of April, early May, it's still an uptrend, and we expect the S&P 500 to follow suit. Here's a longer-term view of that same presidential cycle pattern indicator. It didn't do that well as a forecaster of what the stock market was going to do during the first 2 years of President Trump's term. And my best explanation for why that is President Trump has been a different kind of president than we've ever had before. He's starting to become more swamp dweller and more like the way that presidents and political calendars operate. And so we're seeing the stock market fall more into line with what this average pattern says. But generally speaking, the third year is a steep up year. The fourth year, or the election year, is also an up year on average, although not as steeply because people start worrying about the next election and what that's going to mean for stock prices. Aaron mentioned, on that same topic of the third year, here's a comparison of the current S&P 500 to what we saw in the first 3 years of President Clinton's term in office. And very, very strong correlation between the two. It got a little bit out of whack in the Q4 of 2018 when oil prices led stocks lower, but now the two are dancing back together again. There's a little bottom that's due this week that we saw in 1995. Slight pullback wouldn't bother anything, and then we get back to following the uptrend again, assuming that we continue to match this pattern. Aaron mentioned the breakdown in gold, and here's a chart of June gold futures. This is current through yesterday, so it doesn't have today's price action on it. But what we're seeing is a big head and shoulder structure that has now finally been broken. The importance of a head and shoulder structure is not that it is definitely a top or a bottom. It's an important structure only when you get confirmation, and the confirmation of a head and shoulders top is when the neckline gets broken. And that happened with some authority on Tuesday. It got broken, and we saw it close all the way down below 1280. That neckline is about 1290. And the reason this is important is that then it creates a measuring objective. So you take the height of the head above the neckline, whatever that distance is, you take that same distance and apply it from the point of the break downward, and that's where your downside objective is, which is around 1225. It's not going to get there all in one day. Probably going to take a month or two to get that work done. But so that's the objective. Now, don't make the mistake of thinking that an objective is a guarantee. It's not. An objective's purpose is to tell you when to cover once the price reaches there. It could go beyond there. The breakdown could fail and it could turn up, so you have to have stops in place to manage that. But that's the expectation from the structure. What's also interesting is that as gold prices have broken important support, we also saw similar breaking of support in silver. This is the May silver contract, again, current only through Tuesday. It had important overhead resistance at 15, which was continued in late 2018. That overhead resistance turned into support, but now it's been broken. The downtrend line is intact. So we have an intact downtrend with lower highs and lower lows, and the support has been broken. So silver is confirming the breakdown in gold, and that says not very good things about the prospects for the precious metals complex. Turning a little bit to interest rates, the Fed, by all accounts, appears to be on pause, and that's as it should be. This is a comparison of the Fed funds rate, that's the black line, versus the 2-year Treasury note yield, which is the green line. And I've been advocating for a long time that the FOMC ought to outsource the job of setting interest rate policy to the 2-year note yield. We've got all those 12 PhDs sitting on a committee arguing with each other about what the economy is doing. Well, if they just would listen to the 2-year note yield, they would likely get a better answer. When the Fed gets behind and the 2-year note yield is going up and the Fed doesn't raise rates as quickly, well, then you get things like the housing bubble and you get the internet bubble. And then the last decade or so, we've got the everything bubble when asset prices of all types are being inflated. Right now, we've finally gotten these two, or they're back into balance. And if the Fed could manage to keep them right on top of each other, then we would not have an overstimulus or an understimulus. We wouldn't have the problems of creating the 2007 bear market that the Fed had by being asleep at the switch and not cutting rates fast enough and soon enough. They also gave us a problem with the collapse of the internet bubble being worse than it needed to because they were asleep at the switch. So hopefully they won't be asleep at the switch this time. But based on their long track record, that's not really something that you can base a plan on. That hope, as my old boss in the military said, in military operations and in birth control, hope is not a strategy. So hoping that the Fed will always do the right thing is not the basis of a sound plan. But for right now, they're back in balance, and that's a useful thing because liquidity is plentiful and the Fed's not stomping on it. So we can continue to have the third-year bull market just like we're supposed to. Now, I can go back through any of these charts if we want to answer questions, but I figured I'd give you a pitch. If people want to learn more about the work that we do, come to our website. You can sign up for one of our subscription products. You can sign up for our free weekly chart and focus letters, which also get posted to the Top Advisors Corner on stockcharts.com if you want to read them there. No strings attached if you sign up for the chart and focus. We don't send you any spam or any offers or anything. It's just a way to get more people acquainted with our work. And with that, I'll toss it back to you guys.
All right. Sounds good, Tom. First of all, great presentation. Really enjoyed it. Some of those charts amaze me every time you come on here. The fact, especially like you said, crude oil prices, overlaying those 10 years later to what the stock market's doing makes no sense to me whatsoever. But it's amazing how closely the two are tied.
And, lots of things in the stock market aren't required to make sense. It would be nice if they would, but you don't have to understand why electricity works in order to turn on the light switch and illuminate the room. You don't have to understand the linkage of crude oil prices to stock prices over 10 years in order to see that it works and to get the answers about what lies ahead.
Yep. All right. Good enough. All right. I got a question for you on gold. You mentioned that you pointed out the Head and Shoulders breakdown. I too was watching that 1280 level and saw that we had broken down on the price of gold yesterday. We closed at 1277, so we definitely got the breakdown. You can see with the gold futures, that chart that you're showing there. So short term or short to intermediate term, you're looking for that move back down to your objective there, just above the 1220 level. Do you have any longer term predictions on gold? Do you have any thoughts on that?
I do, and they're very bullish actually. I didn't bring a chart, but one of the fun discoveries came from looking at the price of uranium. You think, uranium? What? Why would anybody care about the price of uranium unless you're running a nuclear reactor in your backyard, which I'm not, but I don't want that rumor to get out. But it turns out that the price movements in uranium tend to lead gold prices by about 7 months, which, again, is ridiculous. It doesn't make any sense. Shouldn't work that way. But, after you see it working for long enough, you finally accept it. Uranium prices have been moving up, and so that should create a bullish uplift for gold prices once gold gets done with the mission of doing whatever it's going to do with its head and shoulder structure. So that could be a temporary interruption in terms of gold answering the bell from uranium and heading higher, but eventually that should work, and uranium prices should lead the way for gold prices to head higher.
Awesome. Another question. This one came in from the room. Well, the question is the crash in small caps today a concern? I don't know that I would call it a crash. It is down about 1%. It's certainly down more than the other indices. But I would just say this. Are you concerned at all about the fact that small caps over the past couple of months, and really even going back further than that, have been underperforming the S&P 500? Because we do have, I know a number of your charts was suggesting that, we're going to go higher, but a lot of these small cap companies do all, or certainly most of their business, if not all of their business here in the U.S., and seeing the small caps underperform, that is one thing that bothers me a little bit. I'd rather see the small caps outperform. Does it bother you at all? Or are you watching the small caps and what they've been doing recently?
That's a short answer. Yes, it's a bother. It does bother me. It's not necessarily fatal, but it's definitely not good news. The overall market tends to do the best when small caps are leading, and especially when small cap growth is leading, or the Russell 2000 Growth Index, which you can track with IWO. If that is leading the way, then that says liquidity is in the best possible condition, and that liquidity is going to flow everywhere and help everything. When it's not that working that way, the major averages can still head higher, but it is a concern. It is a concern that can get itself resolved, and so for now, it's not a signal. It's not a definite. It's just a condition. It's not a signal, but it is a concern.
Mm-hmm. Yeah, no doubt about it. And I'll say, leading into throughout 2018, we were getting that strength in the small caps on a relative basis first half of the year. And when the small caps fell apart the second half of the year, that's when, of course, the overall market took a pretty big hit. But we had rallied back the first 2 months of the year on the small caps. And it just seems like we've kind of given up that relative strength here over the past 6-7 weeks. So I certainly understand the question that was coming in. Another question that came in, did any of Tom's charts or research predict the 2018 year-end decline? So in the fourth quarter, with that huge drop, was there any of the things you talked about that you feel kind of, might have indicated we were going to see that kind of weakness?
Well, I'm showing the comparison of crude oil 10 years forward to the Dow, and for about the last 9 years, I was wondering what the Dow was going to do to replicate or not this big decline that we saw in crude oil prices back in 2008. It was an absolute crash. I don't know if everybody remembers, but crude oil went up to $145 a barrel for about a day, and then it crashed all the way down to 37. And so it was a huge event. Part of that came about because in 2008, the stock market wasn't working as an investment. And so everybody said, hey, let's all pile into commodity index investing. And so you had all sorts of hedge funds that were buying baskets of commodities. And so it was a very weird condition in early 2008 when you would see rice prices and nickel prices being in positive correlation, which makes no sense. Those are unrelated markets, not attached to anything, but they started moving together. And that's because people were pouring money into these commodity baskets and driving up all the prices of all the commodities, because that was what the current fashion was back then. That resulted in a big blow off top in June 2018. And so because that was so far above trend, you had to balance it out by going so far below trend with the bottom in January 2009. These are monthly closing basis. And so the question that I had for about 9 years is, are we going to see the same magnitude of a decline in the stock market to match that? And that's a reasonable question, because there have been other events in the crude oil market that have not shown up in the stock market. Back in 1990, crude oil prices went from 22 all the way up to 40, and then back to 22 again, because Saddam Hussein and the Republican Guards Army annexed the 19th province, which we know of as Kuwait, and that caused oil prices to double. Well, we did not see that oil price event happen and get replicated in the stock market 10 years later. This didn't show up. So if you put your thumb over this spike, then the correlation was still working. It's just that this was an exogenous event in the oil market, not a real supply-demand message. And so that's why it didn't flow through into the stock market. So that's the question I'd had for 9 years: was this big decline, was that the same sort of exogenous event and not a supply-demand message? And how is it going to relate to the stock market decline? We did see the big sharp decline in the stock market. It just wasn't of the same magnitude of giving up 75% of the value, but it was still right there and right on time. And then we saw the oversold bottom in December, a month early versus this 10-year leading indication. And now we're in the rebound phase that crude oil says, and that should continue into 2021. So yes, that was the one thing that forecasted it best, but it was really hard to read because of not understanding how could the stock market replicate that.
Yeah, and I think too, if you go back, like you said, kind of put your thumb over that 2008 peak in oil and the 2009 decline, just kind of take both thumbs and cover that up. You do have a steady uptrend from 2006 through 2014 that, looking forward on the S&P 500, maybe that means we're going to, or on the Dow, depending on what you're looking at, but would seem to indicate that maybe we are going to see that continuing rise for the next 4 or 5 years. And the other thing that this is interesting, or I think makes this interesting, Tom, is it kind of lines up with the time frames of many of these secular bull markets that we've been in, where you go up, 17, 18 years. I mean, if you consider that the bottom was in March of 2009, and you go out, 15 years to your 2024, 2025, that would take you out about 15 or 16 years, which is pretty close to the length of some of the prior secular bull markets. I don't know if you had thought about that at all.
I haven't thought about that as much, but I'll take it. If we're going to see stock prices do exactly what crude oil did, then we can look forward to a top in 2021 and then a long sideways period of choppiness, which again, that'll be a great time for market timers. Buy low, sell high, buy low, sell high, rinse and repeat, and then that'll work until we get to about 2024, and then oil prices had their big decline, and I think that's going to be a real problem for whoever gets elected president in 2024. They're going to be dealing with a big crisis, and they're going to get blamed for it. But then it'll all rebound starting in 2026. So write those dates down and put them on your calendar, or just subscribe to our newsletter, and you get to see the chart periodically, and we'll talk about it as it's happening.
Yep, and as crude oil prices goes up and down, in addition to the short-term impact that it's having at the pump when you go to get gas, it also is having an impact on your portfolio 10 years down the road. So definitely keep that in mind. There was one other question in the room, and that was, how can I get the bond CEF AD line? I think you were talking about that earlier in your presentation. Is that something that the viewers can get a hold of?
It's something that we calculate ourselves, and it's something that we feature in our newsletter when it has something useful to say, like it does right now. And so that's the only way I know to get it, aside from distilling all 3,000 stocks in the NISE yourself and counting up what they do, and it takes a lot of programming work, which I was willing to invest in because it really gives a cool indicator that gives great insights. But that's the only way that I know of to do it. You can approximate it by looking at some of the junk bond ETFs. So, for example, JNK or HYG, they are going to show strength and they're going to show weakness. It's not going to be exactly the same as this advanced decline line, and they're going to be cap weighted from some of their bigger issues. So that's going to skew it versus a more egalitarian, every man gets a vote kind of an indicator. But they are well known for showing divergences at important tops. They're not as well known for showing divergences at bottoms, but when you are seeing junk bond strength in those, that can be somewhat of the same message.
Okay. Does it bother you at all looking at this chart that your AD line there is just starting to roll over with the S&P 500 going higher, or do you need more information than just that little tick down?
It's saying this is something to watch, but it's not saying that this is a problem yet. Okay. We need a divergence over a little bit longer duration than just a week in order for it to be meaningful, and so it could be just a momentary anomaly.
Okay. One last question, then I'm gonna let you go. If we do in fact go higher in the S&P 500, and certainly a lot of what you pointed out here points to that, what does Tom McClellan do in the stock market? I mean, do you look for relative strength to kind of guide you where you want to be in the market, or do you trade ETFs? How do you approach the stock market?
With ETFs and mutual funds, and we're long the S&P 500 right now, and our managed account program that we sub-advise, it's done at a different firm. And then the nice thing about that is that I don't have to register with the SEC and have them knock on my door and do an audit. Somebody else gets that headache, but we still get to engage in the money management business. And if people want to find out more information about that, it's on our website. That's what I'm doing. My focus is on trying to figure out what the overall stock market is going to do, more so than looking at individual stocks, because I think that there's better answers for the overall stock market than there are for individual stocks. So that's where I put my focus.
Makes sense. All right. It's always a pleasure to have you on here, Tom. Really appreciate you stopping by today, and we look forward to having you back on Market Watchers Live soon.
Sounds great.
All right. Thanks so much.